Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, Lecturer Finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Business Finance, and the course code of this subject is BS 151. This is our lecture number 18, and in this lecture, we will be talking about amortization of a bank loan. The outline of this lecture comprises of the concept of loan amortization. Second, the steps involved to amortize a loan. Third, implication and application of time value of money to amortize in equal installment. And fourth, the usefulness of amortization. Dear student, after listening to this lecture, you should be able to understand three learning outcomes. Number one, understand what is loan amortization or what is an amortization. Second, understand how to amortize a bank loan by using the time value of money concept by converting the loan amount, which is the principal you have taken as loan, in easy installment of ordinary annuity. It means that after taking a bank loan from any bank, the bank usually asks you to pay out the equal monthly installment or equal annual installment at the end of each year. In that case, the bank actually transform or convert the principal amount of the loan in easy installment of ordinary annuity, which we will discuss shortly in this lecture. Now, what is an amortization? An amortization means that you have taken a borrowed certain amount of money from any banking organization. Let's say you have borrowed $10,000 from any bank, and the bank asks you to pay out this loan in 5 years of time period of equal annual installment. Then the annual payment or at the end of each month, the customer will be obliged to pay out $2,000 if this loan is Qarze Hasana, or if there is no interest, compound interest involved in this case. But however, usually the banks charge certain amount of interest, which is common in any conventional financing, and this compounding interest rate, which is usually charged in conventional bank loan, make the payment greater than this $2,000 because this is the annual year-end principal payment, plus you need to pay out certain amount of compound interest annually, which we will discuss this scenario in our coming slides. And final learning outcome of this lecture is to understand the usefulness of loan amortization for investor or bank or the banking or the business organizations. Let's take an example to understand the loan amortization. Julie Miller is looking to borrow $10,000 at a compound annual interest rate of 12% from a bank. Maybe there is not written, but let's assume that she is going to borrow $10,000 from any bank, which is going to charge her 12% compound annual interest rate. And the question asks you to amortize the loan if the annual payments are made for 5 years. It means that the Julie Miller is going to borrow $10,000 from any banking organization at the rate of 12% compound annual interest rate, which she is going to pay back in 5 years of equal annual installment. Now, what are the steps involved to amortize a loan? Number first, You need to calculate the payments per period. Here in this case, we are required to find out the payment per period, means the payment at the end of each year the Julie Miller is supposed to pay. Second, determine the interest in the time period T. As this question, which was previously mentioned over this slide, this was telling us that the bank is going to charge her 12% interest. Therefore, the step 2 involved in amortizing a loan is to find out the interest in the period, that how much interest Julie Miller is going to pay at the end of each year. The formula for calculating the interest payment along with the principal reimbursement is the loan balance, means the remaining balance or the remaining loan amount she is going to pay to the bank at T minus 1, means if at any particular time, let's say if T is equal to 2, that means at the end of second year how much interest she is going to pay to the bank. T minus 1 means you need to minus 1 from the current time period, and it will mean that the first year end remaining balance of the loan, which we will discuss in our coming table in a practical example. But you need to understand the formula to calculate the interest rate is that remaining loan amount multiplied by the compound interest rate divided by the compounding frequency. If compounding is more than once per period, that is semi-annual compounding or quarterly compounding, so therefore in that case you need to adjust this compound annual interest rate accordingly. But in our case, the compounding or the frequency of payment is only once per year. Therefore you need to divide anything divided by 1 is equal to actually the same resultant value. So therefore the 12% will remain intact. The third step to amortize the loan is to compute the principal payment in the time period T, current time period. So the principal amount, that is the equal annual installment which is going to be paid by Julie Miller to the bank, will remain a particular same payment, which will comprises of the principal reimbursement along with certain number of dollars as interest payment. So the total payment calculated in first step minus the interest calculated from the second step will give you the principal amount which Julie Miller is going to pay back to the bank. The fourth step involves determining the ending balance in period T, as we have taken the example of second year. So after paying out this payment per period, a particular installment, the leftover balance which she is going to pay in the next 3 years will need to be determined, and the procedure is the balance available in the prevailing year minus the principal payment from step number 3, and it will give you the remaining balance or ending balance in time period 2. And the final step is to start again at step number 2 if there are years to go to pay out the remaining balance, which is 5 years of loan in this case. So therefore we need to start from step number 2 for 3 more times in order to amortize the loan completely. Dear student, let's see how to do or perform these 5 steps. We have taken the same example that Julie Miller is borrowing $10,000 at a compound annual interest rate of 12%. Amortize the loan if the annual payments are made for 5 years. The first step is to find out the payment she is going to pay to the bank at the end of each year. The general formula to find out the payment, because I have already told you that this annual payment is going to last for the next 5 years, and it is usually the equidistance payment, equal 5 years of payment, and which are at equidistance of 1 year time period. So therefore we can assume that, or we can consider this scenario as the ordinary annuity case. So the general formula to calculate the present value of an ordinary annuity is PV naught is equal to the year and annual payment or receipt equidistance in this case, and then needs to multiply by with present value interest factor for ordinary annuity at I compound interest for n number of period. The next step is to plug in the data. Present value she is going to borrow from the bank is $10,000 because she is going to receive this amount as present value, and we are interested to find out the annual payment to the bank, which includes not only the principal amount but as well as the interest, which is 12% compounded annual interest rate. So you can pick this annual interest rate and plug it into the I, and this loan will last for 5 years. So after plugging the relevant data in this formula, we need to find out this factor from present value interest factor table, which are available in the annexure of any financial management book, which I have explained in my previous lecture how to find out the factor in 12% and 5/5 row of n number of time period. You will find a certain factor which will be 3.605 in our case. So dear student, after plugging the relevant data into the equation, we can find out the unknown amount, which is R, by simply dividing both sides with this factor, and it will cut off, and the resultant annual payment will come up 2,774. Now this is the annual payments per period, which is yearly payment in our case, needs to be paid by Julie Miller to the depository institution or the financial institution from which she has borrowed this $10,000. Once again, let me explain you that this is going to be the annual year-end payment, this 2,774. This is going to be the annual year-end payment which will last for 5 years, needs to be paid out to the bank as loan reimbursement or loan amortization amount. Now this 2,774 includes not only the principal amount returned to the bank but as well as this 12% annual interest rate. Dear student, in our next slide we will make a loan amortization table which will explain the scenario in more detailed fashion. First of all, we need to draw 5 columns and 7 rows. In the first row, you are required to write down the title of each column, starting with the end of the year. The second column will be the payment amount, which is the ordinary annuity equidistance payment needs to be paid out to the bank as loan reimbursement. Then you need to figure out the interest amount you are going to pay out of this first payment, 2,774, and as well as you need to bifurcate interest and the principal reimbursement. It means that out of 2,774, certain number of dollars will be interest paid to the bank as profit, and certain number of dollars will be considered as the principal reimbursement, and the final column will show you the remaining balance or outstanding balance which need to be paid out to the bank in next 4 or 5 years. So let's start with time 0. This is the time you have borrowed $10,000 from the bank or any depository institution, and the ending balance column is showing you 10,000 outstanding balance which needs to be amortized or needs to be paid back to the bank. At the end of first year, as we have calculated the payment per period as $2,774, which the customer Julie Miller is supposed to pay back to the depository institution. From this amount, what is the contribution of interest she is going to pay to the bank, and what part of this amount is going to settle down the principal amount? You need to understand this second step carefully. How did we calculate this 1200 interest? The simple formula is the remaining balance, which is 10,000 in our case, and the compound annual interest rate the bank was charging 12%. So you need to divide 12 by 100 and it will give you the annual interest rate the Julie Miller is supposed to pay at the end of first year. So with the help of this formula, 10,000 principal amount multiplied by 12 divided by 100, it gives you 1200 interest. So you have calculated 1200 interest needs to be paid back to the bank. So after calculating interest by applying the rate on your remaining balance, the things get easier for you to find out the principal amount you have paid in your first year payment. So now it's very simple to calculate the principal amount. The total number of dollars at the end of the year you are going to pay to the bank is $2,774, out of which you have paid $1,200 considered or paid as interest expense. So you can simply subtract interest from the payment amount and you will get the principal amount needs to be settled in your remaining outstanding balance. So it is 1,574 by subtracting interest from your payment amount, which is 1,574. And the final step to find out the ending balance is very simple. You need to minus this principal amount 1,574 from your ending balance, previous T minus 1 ending balance, 10,000 minus 1,574, and you will come up with the remaining loan amount needs to be paid back to the bank or deposit institution in our next 4 years. In a similar fashion, let's take the year 2 at the end of second year. Once again, the Julie Miller is going to pay out $2,774, out of which how much bucks are interest and how many dollars belong to the principal payment. So this is the point you need to understand very well. At the end of second year, you have paid once again $2,774, and the remaining balance you need to pay to the bank is $8,426. So therefore, once again, $8,426, you need to take the remaining ending balance or outstanding balance, once again multiply by 12% compound annual interest rate, divide by 100, and it will give you this $1,011. Bear in your mind that the exact value might be something like that, 0.12, but we have rounded our values in order to avoid the decimal places, and this rounding will result slight difference in our final year payment total amount of payment. It could be $1 or $2 slight difference, but it doesn't matter a lot. So the second year's payment is $1,011. The principal amount needs to be settled will be payment minus interest expense will give you $1,763, and once again you need to minus it from your remaining ending balance 1,763, and it will give you the remaining outstanding loan amount which is supposed to be paid out to the bank in next 3 years of installment. In similar fashion, third year payment, interest calculated with the help of this formula, and then minus it from your principal amount, and you will get the principal payment paid out to the bank. Once again, minus it from your outstanding balance, and you will get the ending balance for year 2. Similarly, fourth year payment, and then the fifth year and payment. Slight difference, which is 2,775, is due to the rounding values we have taken for interest and principal amount, which is negligible in our case. So at the end of 5th year, we are going to pay out same equidistance payment, out of which interest will be 297, which has been calculated with the help of the same formula we have used previously, then minus it, and ultimately your loan has been amortized fully at the end of 5th year. Now look at the final subtotals, or I can say the total of each column. The first payment column is telling you that you have paid $13,871 in total for the amount of $10,000 you have initially borrowed from the bank over the period of 5 years. So it means the amount of interest you have paid to the bank is 3,871, which is profit to the bank, and this was your actual or total amount of loan, principal amount of the loan you have paid back to the bank. This was all about how to amortize a loan under the given data. Let's discuss the usefulness of amortization. What is the benefit, or what are the usefulness of this loan amortization for investor, business organization, or a banking organization? The first benefit is that you have determined the interest expense. In our previous slide, we can see that this investor or the banking organization is clear regarding the interest expense he or she is going to pay at the end of each year, which she can adjust. Interest expense may reduce the taxable income of the firm. So at the end of each financial year, if the investor Julie Miller or her company is going to find out the taxable income or net income, so there she can adjust this interest expense, which is useful to determine at the end of each year that what is her interest expense over the bank loan. And secondly, we have calculated the debt outstanding. That is to mean that at the end of each year, we know step by step that how much principal amount is remaining at the end of each year. This is the second benefit of loan amortization table. The quantity of outstanding debt may be used in financing the day-to-day activities. The bank also know that how much amount the bank is receiving in principal and how much amount bank is receiving as interest revenue. So therefore, the bank can decide for the application which she is going to receive in near future for loan purposes, and the bank will be clear about the principal amount available time to time so that it can finance day-to-day activities of the firm. So this was all about the loan amortization and the time value of money concept, which has been incorporated in the loan amortization table to find out the present value of ordinary annuity. That is, the main point was to calculate the payment per period, which was very important, and the later steps were quite easy. Thank you very much for listening to this lecture. If you have any question, feel free to post them on KCMS or email me on my registered email, and I'll be happy to answer your question. Good luck for the day. Allah Hafiz.